Okay, guys, thanks for joining us today. One thing I mentioned at the beginning of all these webinars is watch this again relatively soon after. I'm recording this, so when we send this out, watch it again because it will help you remember this. It'll go into your long-term memory, and you won't have to review as you would if you waited a month down the road. All right. And I'm not going to lie to you guys. You can go online and figure out how to do this strategy. But one thing that you're not going to find out is how to increase your probabilities with this and how to set this up like a floor trader, where I'm going to show you how to pick your strike locations. That's something that they're not going to tell you online necessarily. All right. So let's get on with it. This is still part of our options training course. This is options for intermediates too. Now, if you are a relatively new trader to options, especially, you might want to go back and watch some of those earlier ones because we really start with the building blocks of options, talk about a lot of the Greeks and things of that nature that we're going to talk about throughout the rest of this course even. So having that basic knowledge will really help speed up your learning process down the road because you won't be worried about those little stumbling blocks that you've kind of popped over. Hi, Eric. Hope you're doing well. I will never miss reviewing the recordings. I appreciate that, Farshid. I appreciate that. Yes, because it will help you remember it for sure. And some of the nuances. The first time through this, you guys, some of the, especially if you're learning it new, you'll catch the major stuff, but some of those little nuances might be missed by you as you're trying to learn this strategy in general. So watch it again so that you can pick up those nuances because those are the really important nuggets of information that I'm trying to give you guys. All right, so this is a strategy, again, to use with a long-term, sorry, you should have a long-term bullish assumption in there for this one, sorry. And then on to the long call calendar. This is also similar to that strategy that we talked about with the diagonal, that in that only we're using separate expiration cycles, okay? We are going to be using different strikes as well. So keep that in mind with the long call calendar. But it is a calendar because we are going out on the calendar option montage, if you will, is the way we used to explain it. It's a calendar because you're going further out in time. Trevor giving me the wolf pack stuff. All right. I got to go over a couple of things, so bear with me here for a minute, you guys. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please trade all of this stuff that we're teaching you in your portfolio in your own way, all right? I'm teaching you guys how to do this, but I'm not trying to do this so that you guys just take the trades that I do and implement that in your portfolio. I don't like doing that because I don't know what's in your portfolio, and what I'm doing could be counterintuitive to what you are already doing in your platform and your portfolio. So I started out trading in college with some money I'd earned, and I was trying to get a psychology degree, but started liking the trading more in the finance aspect of my education a little bit better. So I switched over to finance, graduated with a finance degree, moved up to Chicago, jumped into the pits and started trading. And in that time, I've traded basically everything from stocks, financial futures, commodity futures, currencies, and options on all these products and just about all market conditions. Sorry about that. I'm getting behind on my slides. I'm trying to change my other slide thing that usually works, and it's not. Take a minute to go over this disclaimer. It kind of goes over what I spoke about earlier. Anything we talk about in this webinar should not be construed as investment advice or solicitation to buy or sell any of these securities or strategies. I am going to be talking about, most likely, some stocks that are already in one of my portfolios. I'm not trying to get you guys to go out there and follow along with me. If I'm talking about it, it is only for educational purposes. If you want to watch the daily market commentaries, you can find out why I have those market assumptions, but I'm not going to go too into detail. But keep in mind that you will see stuff in my portfolio that I may very well have on already. And please remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right. Finally, you guys can follow me on Twitter at Wolfman's blog, or you can follow our parent company at ProTraderStrat for all kinds of market wisdom. Now, like I mentioned, this is on this is on the long call calendar. And this is how we're going to build it out. Hold on, I see. Didn't you get coffee before they let you get in the pit? I drink a lot of coffee. I can drink about a pot of coffee a day. So I would have had IV of coffee had they allowed me to have that on the floor. But no, we weren't allowed to have food or drinks on that floor. So that was a bit of a bummer. And you would get fined a lot of money if you did do that. All right, so the call calendar, and we're only going to be looking at the long side. I'm not going to even teach the short side. I don't like being short an option 250 some odd days out or 200 days out. I don't even like being short options past like 50 or 60 days. So I'm not going to teach a strategy that I would not implement in my portfolio. So that would be the short call calendar. The long call calendar, though, is one that I really like because this is great when you're in those lulls or you're in those in-between areas of the market where we don't have earnings coming out and, they've all just come out. We're seeing the market make its move with not a whole lot of data coming out. So that's usually when we get those slow grinds up. So this is a great strategy for a long-term bullish assumption. With that being said, it's also called a long horizontal or horizontal spread, just basically out on the horizon. And how we're going to set this up is we're going to basically start looking at like a slightly out of the money on the selling. It says at the money, and that's being really aggressive in that near term. I like to go slightly out of the money, maybe around a 36 delta for this near term expiration. And that one is going to expire in about 45 days. And then we go further out on the calendar and we're going to be buying an at the money or just slightly out of the money call in the further expiration. So remember, when we were doing the diagonal, we were buying in the money calls. That's what makes this one a little bit different. Our strikes are going to be located at the same spot. All right. So essentials to success. One of those main essentials that before we start implementing a stock or an option trade around a stock, we need to make sure that those options have some open interest and that there's a lot of participation in there. One thing that I think many newer traders of options get stuck in a rut about is that they're trying to trade options around some stocks that they're very familiar with. Well, what they don't really realize is that when they are looking at some of those stocks, people may not be trading options around those. So the market may be very good for the stock, but because there's no participation in the options, I would suggest moving along to another stock to trade. And what that comes down to is having a really wide bid ask on the option montage. So we can look at something like Aon. Hopefully Aon has some wide markets for me to make an example, bad example out of them for. But a lot of people have heard Aon, right? I mean, they are a global company and they don't have a ton of participation in there, generally speaking. You can see these bid asks are a little bit wide. Some of them are 15 cents to 25. It's actually pretty good for Aon. But my rule of thumb for picking the right underlying is to look at this option montage with about 45 days to expiration and just make sure they're pretty tight markets. The reason why you want tight markets is because you don't have to give as much of an edge to get in as you would any other stock like an Apple or a comparable priced stock. So my rule of thumb on picking the right underlying when you're looking in the option montage, move the decimal place 3 ticks to the left for any stock over $100. 3 ticks to the left, that's how wide these bid offers should be, and that's about 14 cents. So Aon, believe it or not, is following in line with that rule. It's about 15 cents. It's pretty close. But and some of them even get a little bit tighter. So Aon starting to get more participation going on in their stock. But you can see there's only been about 3 puts traded and a couple of calls. So that's where I'm talking about. It's going to be difficult to get somebody to come in and trade with you a lot of times. So we want something that's really tight. We could look at something like a similar priced stock and Apple, and look at Apple for a similar price, and it's a $200 stock, move it 3 ticks to the left, we would say 20 cents. But look at these. These are going to be a lot tighter. You can see 3, 4 cents. This one's, maybe 10 cents. It's after the market though, and those are really close. But you can see they're a lot tighter even than Aon as a lower price stock. If the stock is under $100, great question. If it's under $100, it's 10 cents wide. That's the rule of thumb. Under $100, as long as it's 10 cents wide, we're good to trade it. If it's over $100, we just move it 3 ticks to the left, and that's how wide those should be. Trevor, what are you saying there? I see somebody asking a couple of questions. Hold on, I'll start off with John. What's the net change column you're looking at? Is that the volume? Right here, net change. I don't know why that's on there. I was playing around with this not too long ago and trying to do like high, low, and building my own things. So I just kind of played around with it. I usually look at the deltas and then all the gamma, or all the Greeks, I should say. So that's not one of my main screens that I normally have. It just happened to do that. I play around with this thing all day long, and it just got left up there. The call diagonal in T worked. In AT&T it worked? Yes. Of course it did. That's the one I didn't do. I'm glad you did that one because I did the one on IBM, and it is not working out very well. Oh, actually, no, I did. You're right. The call diagonal did work out. I got the butterfly stuck in my head that I did for IBM not too long ago. That one's not working out very well. What was the other one? John, volume. Is that the volume? Yeah, some of that stuff is the volume, like how much has been traded during the day and stuff like that. How do you know the open interest and the volume? Well, you can on TD Ameritrade, you can see open volume and open interest. That's actually a click there. So you can see what the volume is for Procter & Gamble today and the open interest, which means these are people that have openly held contracts and options in these strikes. And these are all the people that traded today and the amount they traded. So you can see a lot more being traded there than what we saw in what would have been Aon. We'll see on Aon, there's just almost no trade in there, see? And very little open interest comparatively. So what this tells you, when there's a lot of open interest, you guys, that means there's a lot of people in there with eyeballs on this market because they're constantly checking it. When you have a position on, you're looking at it, right? This has a lot of eyeballs in there. And what that does for you is, if I wanted to buy one of these options, I might only have to give up a couple of pennies in either direction to get in. Whereas if it's like 25 cents or 50 cents wide, then you've got to give up a big edge to get in because, for one, there's only maybe one person in there trading at the time you're doing it, and they're just going to wait for you to come to them. So all of that, it adds to your risk. So when you're newer to trading options, make sure you always check this to see that you have tight markets and a lot of open interest. And that is when we're trying to select the underlying that we're going to trade. Also, picking the right strikes. Now, I kind of mentioned this. If you have more of a neutral directional bias coming up, they just had earnings. They nailed the earnings right on the number. Forward guidance was pretty, ho-hum. It's not a super exciting stock. It's probably just going to grind up, all right? That's the kind of situation we're looking for this, even more so than we did in the diagonal. The diagonal, you remember, we talked about that slow grind up because we want those short options to expire worthless. And with that being said, the call calendar really wants a slow grind. We do not want it to move fast because our short option is going to be a lot closer to the market than what we were using with the long call diagonal. And one of those reasons is because we can't pay off that extrinsic value like we could with the long call diagonal in the long call calendar. Over time we will, maybe after one roll, the ultimate goal is to try and get that paid off right now. But keep in mind, because it is a calendar, there's a lot of theta decay in that one we're buying, and there's not very much theta decay left or extrinsic value left in the option we're selling. Now, I just mentioned for some of you guys that are maybe new, intrinsic and extrinsic value. Extrinsic value is really ancillary to that option, okay? It's time decay is what that really represents. In the money options, these ones that are below where the underlying is trading, so for instance, for the calls, it's trading 142, so all of these are in the money options. They have intrinsic and extrinsic value. Intrinsic value is what this option is really worth. So we got pretty easy math here. The 140 strike has how much value? Well, the underlying, let's just say last traded at 142.04. So there's $2.04 embedded in this option. That is what it's really worth. All of the other stuff is icing, it's fluff. It's going to go away. So we know what it's worth, $2.04. We would want to try and pay off that extrinsic value. Now, we're not going to be able to do it in the first setup like we were with the diagonal, but we want to have that goal of being able to pay off all of the extrinsic value by at least the second roll. And that is very attainable when we're trying to set up this strategy. So picking the right strikes, we're going to start with right around a 36 delta. If you have less of a directional assumption, you think it's going to grind up, but maybe really slow, you can go a little bit closer and maybe pick like a 45 delta option. So when we're looking at the option montage, we need to have this delta up here. So we would be selling the 36 delta, so $2 higher on the option we're trading in the next 45 days. That's relatively easy to accomplish for a stock, you know, for Aon in particular. So we have to be wary of that. We want that short option to expire worthless, and to expire worthless, it needs to expire out of the money. All right. So that is one of our major goals in this, is to let this option expire out of the money. And if you don't have like a 36 delta, you know, you're going to try and start at that 36 delta option and then move a little bit further away and see if you can accomplish it that way. Okay. So always start with around that 36 and then try and get away from the market further out of the money if you can. And I see a couple of questions coming up, so I'll try and attack those real quick. How do you know when the open interest, we already did that. To pick out the unusual option activity. Yes, you could do something like that with the option activity for sure. If you are a fan of the Nigerian brothers, which, you know, I agree with their theory on that, as a matter of fact. And I've actually jumped on a couple of those trades when I've seen them. So yeah, you can definitely do it on something with unusual option activity. And you can see unusual option activity in, I don't know, I'm sure there's a scan for it, but I don't usually use that as my trading directional move. Every once in a while I will, but why the 36 delta? That's a great question. The 36 delta actually lands at about half a standard deviation move. So the idea is, you know, about 65, you know, 2/3 of the time it's going to land out of the money. Now, keep in mind that if it does go into the money, that extrinsic value is still going to decay, but we don't want our short options to ever really go into the money, because then it increases our risk of being assigned on that. So I'd like to get a little bit further out, and I just do it for the math, you know, and I don't believe that I have a bell curve here on this. I don't have a bell curve in here, but I can try and draw one for you. Let's see if I can pull this up. I don't think I can. I don't have the functionality on this for my marker, but you know, a basic bell curve is even on both sides, and a 36 delta lands at a half standard deviation. Then you go to the 16 delta, and that's a 1 standard deviation. That's just 1 standard deviation is just a little too far away than then if you go that far out, we're just not going to be able to collect enough credit to pay off like at least half of our to pay off our external premium. External, I don't know why I have external stuck in my head, but we're trying to pay for that extrinsic premium that's embedded in these stocks. And if you go out to like a 16 delta or something like that, you can see it's almost 50 cents less right away. Yes, our probabilities of getting hit on this or the market running up into our short strike is much less, but we need it. One of our things is we got to pay off that extrinsic value of our option that we're buying, and we're going to need the heavier premium is what it really comes down to. Okay. You said the 36 delta is really where the 35 delta is really where the half standard deviation is. So is 60 delta associated with the statement or the standard deviation? Yes. So like the 36 delta and the 64 delta are equivalent in that half standard deviation move, correct? And the 16 delta and the 84 delta are equivalent to a 1 standard deviation move, correct? Good questions. Very good questions. All right, so picking the right strikes, we got that. Knowing that we're going to start out around that 36 delta. And the duration, this is really important also because we have two different options that are going to be decaying at different rates. How do we pick those strikes or that duration? Well, the strikes I told you about, and again, those are things you won't find online, right? And picking the right duration. In that front month, we want accelerated decay in that option. And this really gives you a visual representation of what, sorry guys, the duration is here. And this is our theta decay. This gives us the representation as to what our premiums are doing in different time frames, right? Now, this is the at the money, which is the ones that we're going to be using or very close to it. So this will be a good representation of what our theta decay looks like to our premiums, okay? And as you can see further out on this line, it starts really slowing down on its angle of descent. But you get inside that 35 to 45 days to expiration, and you can lose 50% of those premiums within that 30 days, 28 days, right? These 28 days, you can lose 50% of your premium. So that's what we want, is that accelerated theta decay happening to our option. I don't usually like to go this far out on the expiration cycle, so I'd like to roll this out in time before the last 7 days. There's a lot of things that go on in those last 7 days that I just don't want to be a part of, especially if you're a newer trader. It's the gamma starts changing around, and it affects those near at the money options more than it does the ones that are further out of the money. And since we're going close, we definitely want to try and avoid that. The other thing is, if we get out, with 7 days to go, it really throws us back into that cycle of back into this theta decay again. And we go through that whole cycle again, okay? And we will be able to usually roll up and away from where the underlying is trading now. So if we originally sold the 100 strike in XYZ, right, and then we rolled it out in time, we might be able to roll out in time and up to the 105 strike and collect the same amount of premium that we did the original time. So that's our mandate here, is to roll out in time, continue to collect more credit, and we're probably going to have to do it at least 2 times, maybe 3 times in some instances. If you can get it done in the first setup, that is like, you hear me talk about green lights. That is a full blazing green light. Like, there is no stoplight at that intersection. Further out, you could say that if it was getting further out the line, that you could make it a yellow light. If you had to do 3 rolls, then I would say, especially if you're a newer trader, I would just kind of say, you know what, there's better opportunities elsewhere. If you're a savvy trader, then you know that going into it, I'm probably going to have to roll 3 times in order to get this done. Okay. Okay, yeah, 35, 64, and 16 and 84. Yes, 34 is 36 delta, 64, you know, that's the 100, 84 and 16, that's your other 100. A total of 100% probability, right? And bell curve with statistical probabilities are those 1 standard and half standard deviation moves, respectively, okay? We want acceleration of theta decay happening to the short option. Absolutely. You are correct, John. We want the accelerated theta decay in the one we're selling because we want that one to go to 0. We want that one to go to 0 right now because then we know we paid off extrinsic value, right? But if we have to roll out again, we're just going to try and roll out and up and away. And I'll go into that when we pull up the option montage here in a minute. Picking the right environment. Again, we want that low vega, like low to middle range implied volatility percent, which is going to be, you know, for a regular stock, it's going to be running right around somewhere between 30 and 50 is really the wheelhouse. You can go all the way down to 0, to be quite honest. But the takeaway here is low vega. We don't want really high volatility in there. Also, with this strategy is the same as what we were talking about with the diagonal, is we don't want a lot of variation in our volatilities of the underlying we're trading, right? So we talked about this with the diagonals quite extensively. These are the options montage and these are the volatilities. We do not want a major difference between all of these unless this one's higher. You know, if the one that we're selling has higher volatility than the one we're buying, we have nothing to worry about. Again, that would be a green light. A red light would be is if these were 5 percentage points in difference. Right now you can see the one that we would be looking to sell is a 16 volatility, and the one that we would be buying out here around 200 days is about an 18. Now, typically when people talk about doing a calendar, they are talking about going out and doing leaps, all right? When I set up the calendar, I don't go out that far. I don't want to be married to any stock for necessarily over a year. So I usually go out about 6 months, somewhere 6 months to a year, depending on how long-term bullish I am. But generally, I will be probably playing around the 150-day mark, okay? And the reason why, it's about half the distance for a full year. It gives me around 6 months. The other thing is, I'm far enough away that I get several rolls. I could sell or buy the July short back in, get short the August, then when those decay away, I roll out to the SEP, okay? And I could even ultimately then roll into the October. But by the time I pay off all my extrinsic value, you guys, I'm going to let that thing ride. I just want to get that extrinsic value gone. So that would give you several rolls to continue to lower your overall initial output of money. That makes sense. Your initial investment. You're lowering you're increasing your yield by lowering your basis on what you traded. Okay. So picking the right environment, somewhere down there in the below a 30 implied volatility percent, and somewhere, you know, preferably upwards of 15% at least. Okay. And major takeaway, do not have more than 3 is the best. That's about as far as I go. You see a 5%, this is 16 and this is 21, walk away. Okay. Because what happens is you're selling volatility in this one that doesn't have any volatility, and you're buying volatility in here that already has a lot of volatility, right? So we're having to pay up in the back and we're not getting paid in the front is the takeaway there. So make sure there's not a big difference in here, because this is a volatility play also. Not only a theta decay, we want that theta decay happening in the front month, but we also would really like to see volatility remain relatively stable throughout this trade for the most part. You know, we wouldn't mind it going up. That's not a bad thing. We don't want it to spike up the day after we put it on, because that's going to affect our front month short option more so than that back month option, right? So the front month will get pumped up with premium, and the back one won't get that much love. So that when we're short, we'll see those, see all that premium start pump up, even though we might be going down in direction. So our call is getting further away from the market, but our premiums are going up. We don't want to see that happen. We would rather have the volatility start to come out of it, because it's going to be affecting that front month one a little bit more. Rolling is to reduce the initial extrinsic value, right? Absolutely. We want to take care of the extrinsic value. And let me finish up with this last couple of slides, and then I'll jump into the platform, and I think it will make everything go a little bit better. You guys will be able to walk through the steps with me to see if anything goes awry. All right, and knowing your exit strategy before entering the trade. All right, one thing we want to do this. We have our pieces of paper right next to us, right, where we're writing down all of our trades, when we're getting into them, why we get into them. Okay, this is how you stay mechanical. When we're going through these lists, essentials to success, and I think I found the one that I'm going to do when I finally decide that I'm going to do it. Write everything down, write all the information down. Why I picked this underline, why I picked the strikes I picked, what the duration was, and the environment. Finally, make sure you write down where your exit is. You are more likely to stay mechanical and get out of this thing if you write it down. I can't tell you how many times I've seen traders say they were going to get out of a trade at a certain level, and when it reaches that level, they decide, you know what, I'm going to let it ride out for a little bit longer, and it goes against you. You can see that happen a lot, and especially in options, because with options, like I said, you can be directionally right sometimes and still not make money. You can be directionally wrong sometimes and still not make money, depending on what's going on in and around what you're trading. And that's why it's important to follow these rules, so you don't get caught in those situations. It's not to say you're not going to get caught. I'm not saying that, because it will come back and defy some of the probabilities. But over the course of time, the probabilities will work themselves out, and those probabilities, the way we are trading them, are in your favor. So the probabilities will work out in your favor. All right. So when the position reaches 30% increase in value is when I'm looking to get out of that. So obviously, if I paid $1, what's an increase of 30%? It's when the underlying, or when my value of my trade is at $1.30. So I would write that down. I paid $1. I'm getting out at 30% increase. That is $1.30, and that's what I would write down. Okay. Does that make sense? If I'm directionally wrong, what I will a lot of times do is, for this one, we're not going to be paying a ton of money for premium, but you can look at it like, okay, if I get to a 30% increase in my premium, or maybe a 50% loss in my premium, I'm going to get out. All right. Does that make sense? John's asking, isn't 68% the one standard deviation probability? No, 68% is, no, yeah, 68% is going to be a half a standard deviation. I might be able to find I'm not going to be able to find a standard deviation chart real quick on the fly. Maybe after I get through this, we'll go through I'll find a standard deviation chart for you guys, and we'll go over it real quick, okay? Is that for all of the roles combined? No, that is not for all the roles combined. That's just like when you see that increase by that 30%. And, you know, if you guys have a higher risk tolerance also, my rule is, you know, I gear these towards the person that's learning. Now, if you've traded options before, or even futures for that matter, if you're a futures trader, then you probably have a higher risk tolerance. And I don't have a problem with saying then, you know, at a 50% increase in premium, you get out. So when it's trading $1.50, but stay consistent. All right. I have found my exit strategies to be very consistent, and that's why I've stuck with those numbers. But I don't have a problem with you guys playing around with different exit strategies. My thing is, pick one, stick to it, so that you have data to back up your theory, okay? And make sure you write it down and you keep track of it so that you can track your own probability analysis, all right? All right, so profit could be considered unlimited because we have that long call. Now, keep in mind, these P&L, the profit, the loss, the break even, they are all theory, okay? Because there's two different option expirations. There's two different volatilities, right? There's two different theta decays. So everything is based on when we set it up on the theoretical max profit, max loss, all right? Volatility moving in two different directions, volatility moving in the front month in one direction, the volatility in the back month moving in different direction. You could see how those premium values changing would affect all of these different numbers other than really the max profit, because actually even the max profit, because the max profit could be limited because of that front month option. It's only unlimited after that front month. It's only unlimited after that front month option expires, okay? Before that front month expires, it's limited to a very tight margin. So our max profit is unlimited only after that short, and we don't do the roll in a sense. All right, our max loss is going to be that premium we paid. Anytime with options, you guys, you pay a premium, then you have limited risk, okay? And our break even is the long option plus the premium paid. Anytime you get long an option and you pay premium, you have to add that to that option, okay? I'm gonna put it, obviously it's gonna be subtracted because then it goes to the downside, but the long call option plus the premium paid, that's our break even. So in that example, the $100 strike, remember, let's just say I paid $2 for it. Then when the underlying is trading 102, then I would be at my break even, okay? All right, so this is where I pull up the platform for you guys so we can all take a look at a platform. And I also like to have this interactive, so please go out there and throw in that questions box. Some of the stocks you guys want to look at for a bullish assumption on a calendar. Remember, we're long-term bullish in this, all right? So that's something we want that likes to grind higher. So just throw in some tickers into the box and we'll try and go over them here quick. And I'll give you a second while I'm trying to read over some of these. Doesn't volatility change both the front month short option and the later month long option? Yes, it does. But they will change at different rates. So let's just look at this for that example. So we're going to look at Vega, all right? Vega is volatility. And let's just say Procter & Gamble was our example that we were going to look at. All right, so Procter & Gamble, it's a $75 stock. One of the first things we look at is the right underlying, all right? We already did this, but yes, you can see it's inside of 10 cents on the stock that's under $100. And when we do that rule, we're looking at those options that are relatively close to being the monthlies that are the spot month in a sense where everybody trades. So that's what we're looking for there. And this is going to be the spot month at this point. All right. And so we've got the tight bid ask on that. Do we have the right volatility for this type of trade? We're looking at implied volatility percent. It's 49. It's a little high. So this is one of those situations where I'm like, all right, well, it's right there at the middle of the road. I'm not completely opposed to doing it with a 50, but you might be able to find better opportunities out there with other strategies that I've taught with around 50 ID percent. But let's say that would be then a yellow because we aren't following that rule necessarily, and it's just a little outside of it. Okay, and for the purposes of example, we'll do it. I'm going to go probably for this October. I like about the 150 days is the best. But we don't have that. So I'm going to go a little bit tighter because I don't want to be married to anything forever. And with this one, I'm going to start around that 36 delta, and we'll just play around with it to see if it works. So I've got 40 some cents to spend, right, on my option for the calendar spread. And so where we're going to start looking to try and pay that off. Well, we're going to be buying this one that's very close to at the money here. You know, this is all extrinsic value. This one's got about $1 in it. We could probably go a little bit further in to try and get it in 2 rolls. I'm just trying to think 75 and 75 is about $1.50 to pay off. So I'm going to at least have to do 2 rolls. What kind of IV rank is preferred, did you say in this? Somewhere below a 30 is the best case scenario. Anything above 30, we're going to 15 here. You know, that's starting to be like a yellow or a yellow to a red light in a sense, because we are starting to get to a place where we are probably going to experience some volatility contraction, and that could really start to affect us in the back month spreads. All right. Does that make sense? Yeah. Sorry, I see a couple things. Sorry, what? Did I answer your question, Wally? Okay, below 30. Yeah, I got it. Yeah, so I'll answer a couple of those questions in a minute here. All right, so we are going to be looking to sell that short in the money one, right? So then we're going to be looking to buy the one. So like Banu was right on it. Like, which one are we going to be buying here? Which one do you like to buy? So we're going to be buying the one that is longer in duration out there, right? To try and take advantage of that. And we're going to be picking the strike. All right, so let's pick a strike here. We're going to be going into, we want to pick very close to the same one. So we're going to probably have to go to the in the money ones possibly to get this done right, because it's going to be going to do. Okay, so we're going to be wanting to buy the one that is in the money there, or right at the money. I'm trying to, let's go off to a different one there. So let's go to a different one, because I think that we're going to have to pay off too much here. And I think it's basically because there's so much volatility in here that it's really affecting these. So I'm going to go a little bit further down, see if we've got another example up here. Somebody else threw out Bank of America. Bank of America. So one of the things we look at that, it's a $30 stock. These are inside of that 10-cent rule. We have something that is very close in implied volatility right here. So that's good. Now, this isn't the one I'm talking about for the below 30, you guys. The implied volatility percent I'm looking for is right here. And what that is a product of is where volatility is now in regards to where it's been in the past. So you can see here, the formula for this implied volatility percent, you have in the numerator and a denominator. In the numerator, you take where the current IV is here and subtract it by the low. That sum, which is 22 minus 18. 22 minus 18, we got 3. So in the numerator, we have 3 divided by the high minus the low, which is 40 minus 18, so 22. So 3 divided by 22 is what? 3 divided by 22 is, I'm coming up with 7%, but that doesn't seem right. 23 divided by 22 is 13%. okay? So 13%, my math is off because I'm rounding, but that's the idea. Take the current minus the low, that sum divide by the high minus the low sum, and that's where you get your IV percent. And it tells you that it's at a low area. You know, it has a tendency to spike up into these areas, but, you know, it has a tendency to spike down to these low areas. Right now, closer to the low area. So it doesn't have a whole lot of downside that we have to worry about. And this chart really is very similar to these charts in that you will find support and resistances and places of complacency where the market gets to settle down, if you will. All right, so that works. One other thing we do want to look at on this is what happened there? I must have hit something wrong there. My chart doesn't want to work there. There we go. That's why I clicked the wrong thing. So let's go on to looking at, so that fits that rule there. So we are going to be buying the same strikes. So what we want to do is look at this 36 delta. This delta is not going to be the same, but what we want to do here is we want to start out with that 36 delta. That's the one we want to sell. We would love to be able to pay off like half of it. I talked about maybe having one more roll. See how this is working out? We're picking the same strikes, and it looks like I'm paying off basically half of the extrinsic value. All right? So extrinsic value, we're paying off half of it. So now our thinking is we've got 2 months we get to roll through, and you can roll through the weeklies to get this strategy done. One of the downsides with the calendar spread, the long call calendar spread, you guys, we're going to be riding this long option sometimes through earnings. Okay, sometimes you have to do that. All right. We're not paying a whole lot for this strategy. So, you know, that's why I was like, usually I'm going to let this thing ride out into the sunset. I'm either going to take my loss of that 68 cents or roll it out a couple of times and hopefully get this option on for free, right? That would be the best case scenario. If anything, we could be long the 31 calls and it didn't cost us anything because we paid it all off. That's what we're shooting for here, is to have a free option on. And if you have that free option on, then you don't really have any risk going into the earnings trade, okay? So that's what we're trying to do there. So Bank of America, I would feel, is a good candidate. Now, if this volatility is ever lower than the volatility we're buying, then that is a no-brainer. We don't have to decide, is this only 3 percentage points in separation? They're very close. It is like these are almost dead on, right? But if this is higher than this is, then that is a definite green light about it, okay? Didn't understand your rule for buying and selling. Okay, so my rule for buying and selling the rule for buying on this strategy and selling on this strategy is, yes, we are doing the same strike, but our rule is to try and pay off half of this value in the one we're buying. Ultimately, we want to do it all paid off, but at least within one roll. That makes sense? Okay. All right, let's look on to another example before we have to go here because we're getting pretty close. AMD, 2 people picked AMD right in a row. Who would have thought? All right, so advanced micro devices. All right, you know, one thing also to note, this is what I was talking about with those earnings coming in there. You could try and land this in the earnings if that lined up good, okay? Kind of like what we did with the diagonals, right? We were trying to buy this one for the diagonal so that volatility we knew would likely increase heading into that event. Definitely you can do that as well on this strategy, especially, you know, if you did it right after the earnings, you would probably be able to land that long option right in a month that had earnings, okay? And that would help our premiums in that strike as well, right? And that's ultimately what we want to go for there. All right, so AMD, I don't have a directional assumption in them, yes, necessarily, but to me, you know, it's grinding higher. Maybe after today, that doesn't look too good, but that could help us with this strategy, right? Because we want that front month to expire worthless. Well, if we are long-term bullish on this and we just see like a minor correction happening, like, well, you don't have one there, but you know, you see one of those minor corrections, you want to take advantage of that. That would be the time to do this strategy, especially if you get that little bit of rollover that goes against you a little bit. Well, that front month is going to decay even faster. And if that happens, then we've lessened our risk, right? All right. So AMD, that looks pretty decent. Looks like they have low implied volatility percent in the 20s. So that fits that rule. It is a $14 stock. Let's look how wide these are. They're only a penny wide, so that's pretty good. You can always just go back and just double check just to see, make sure that there's volume and open interest. And you can say there is a ton of volume and open interest. There's, I haven't traded this stock, I don't think, in at least a very long time, but I want to throw it in my watch list for us so that we can look at some of these things in daily market commentaries, because I don't have enough stuff on medical side to play around. So I need more medical stuff. Biotech. All right, so here's the 37 Delta. This is the one that we're going to be looking to sell. It's about 45 days to expiration, right? That gets us right in that wheelhouse of getting that accelerated theta decay. I'm going to go about 150 days, maybe even creep in just a little bit. And I'm going to be picking the 16 strike here. So I'm going to be buying this one. Now, this one you can see we're definitely probably going to have, or we're most likely going to have to roll maybe 2 or 3 times. There will be another option expiration that shows up in there later on, but that we'll be able to take advantage of. But having said that, you know, only 3% difference or 2% difference here. So we're good there. That follows that rule as well. Can you give us an actual buy and sell example to make the calendar spread work? Well, yeah, this is a good one to work. You know, it's not the best case. You know, I would say if you can't roll it over in, you know, one roll from this roll to this roll, if you can't pay off all of it or don't believe you can pay off all of it in that one time roll, then you have to start thinking, okay, this is a yellow light. I might be, you know, if I really like AMD to the upside, then I might be able to be willing to not follow that rule. So I'd say it's a yellow light. You just know that you're increasing your risk a little bit, right? When you go from green light to yellow light, that's just, okay, my probabilities might be going down a little bit and I'm increasing my risk just a little bit. Okay. Can you, 15 straight, sorry. A couple of questions are popping up and I'm trying to read and it moved a little bit. Can you give us an example of a buy and sell example to make the calendar spread work? Would the 15 Delta strike work better? Well, you know, we might be able to use this 15, 17 Delta strike, but keep in mind, by the time we sell this with the commissions and everything else, we're only getting about 20 cents here, maybe even 30 cents here, but the probability of us being in the money on our long option at expiration is not going to be that great. So we want this option to go into the money in the next 130 some days. We just don't want it to happen in the next basically week or 2 weeks. Okay. So that's why we're going closer there. And this does work. Just know one of my rules on picking the right strikes is that you would like to be able to pay off all the extrinsic value in that first roll. So when we roll it over, that extra premium we get pays off all of the extrinsic value. Now, you don't know that for certain because we don't know what volatility is going to do in the meantime. We can only make a best case assumption, all right? And that's what we're trying to do is that, all right, well, if the premium is here at 50 at around this same delta, you know, next month when I roll, that same 30 some delta option is going, or that 30 delta option is going to give me about the same amount of premium, 50, 60 cents. Now, hopefully that 30 delta option is going to be a couple of ticks higher though, right? Because the market's moved up and we're able to take this one that we were short. If we were short this option and it's decayed to that level, it's about 7 days to go. Okay, I need to make a move to roll this. Well, then what you would do is you just buy this one, and let's say you were able to roll up out in time and go from the, what I had as the 16 calls to the 17 calls, something like that, right? So we're able to roll out in time and up in value and hopefully get another 50 cents, which we are not getting here, but that's because of the duration here. And these haven't decayed. This hasn't gotten to the point. What it would be, let's say we were in this trade where this is the one we were short. Well, the market when we put it on was probably around 16. It's kind of decayed down to here. And now we're looking to roll up and out if we can. All right. You're not always going to be able to, but a lot of times you will. So the first 40 or so days is the one that we want. Yes, we want right around that 40 days to expiration. Is this strategy same for both the short and the long? I would not do a short. Oh, yes. Sorry. Yes. The short. I thought you were going to say short and long call calendar. Yes. The strikes for the calendar are the same strikes, which is also a difference between this and the one that we were talking about, the diagonal. Okay. Does anybody else have any more questions before I wrap this up for you guys? And then after we get done here, then we'll go over the, I'll find a standard deviation chart for you guys, okay? Don't forget the standard deviation. I won't. I'll get you that. I'll find it. It's not my computer, so we're going to have to look it up online. I'll find something for you. All right? All right, you guys, this is the deal for you guys today. $36. This is how to trade options like the Wolfman. There's well over 10 hours of webinars in here. Some of you guys, I know I recognize a lot of your names in here. You guys have heard me say this time and time again, but I can't emphasize it enough. For one, nobody else is going to talk about it, so I feel like I've got to talk about it twice as much because I think it's that important. But protecting your portfolio against rising interest rates. What's going on right now with FOMC? We are raising rates. The next meeting next week is supposed to be another 25 bip hike. All right. This 25 bips doesn't seem like a lot. And they always say it's very minute. And it is. You know, historically, Greenspan would move at, 1 percentage point at a crack. These guys are moving at a 1/4 percentage point a crack. All right. So a 1/4 percentage point hike will, over time, add up to 2 or 3 percentage points. And those 2 or 3 percentage points is going to really hurt the overall value of your portfolio of bonds. Now, keep in mind, if you take it all the way to expiration, yes, those the par value is what you'll get back. But most people only hold those bonds for like 7 years. And what they do is they go out there and they chase yield. You cannot, the pricing doesn't work that way, you guys. The people that are trading these products know that if interest rates go up, the value of the bonds goes down, and they aren't going to allow you to scalp them. Okay. They're smarter than that. They're going to price the bond well below you being able to chase that premium and make up for it. It's going to take you years and years and years before it ever makes up for it. And in that time, you could have been doing what I teach here and not had to worry about it. The way you're trading this is going to be that extra yield you're seeking. All right. And the history options, some fun ones in here too that are really great. And what I mentioned about trading even gamma if you wanted any interest in those market profile and things that I trade off of, I teach about that too. So this is a really good one, especially if you're some newer to this. And I always say, if you guys are trying to learn, you're doing the right thing, because that's the only way you can become a better trader is to constantly learn. And you obviously are doing that by taking this webinar and probably other ones. And I implore you guys to do that as well. Get as much education as you can. But having said that, you guys should be trading with this knowledge, right? With the way I teach, I'm teaching you guys strike location and the reasons why you pick those strikes. Nobody else is really going to be doing that for you. You know why? Because they don't really know. You go on Investopedia or whatever, They don't know why you pick those strike locations. They just know those are the rules. All right. So I'm going to teach you those nuances so that you guys can start thinking for yourselves. You don't have to go out there and rely on somebody else's trade to make money. All right. You're going to be able to do this on your own by taking advantage of this. So go ahead and click on the link in the chat window over there on the side. We've been going back and forth in the questions box, but I just now added that over to the chat box. If you can't see it, let me know. Because I'm throwing it in there a couple times to make sure I got it there. But we're offering this trial for you guys today, so I suggest you really take advantage of it. At this price, that bond portfolio webinar could pay for itself already. And if you learned anything at all from me, you guys should take advantage of this. So what do you say? Go ahead and click on that link and we'll get started right away. And if you guys have any other last minute questions while I'm trying to look up this standard deviation chart with the information. Anybody else? I think I see some. Is the diagonal higher probability strategy? No, it is not. I'd have to do the math. Let me think about it. Yes, it is a higher probability strategy. It's a higher probability strategy because we're starting out with the option that is in the money. So the probabilities of success are ultimately already in your favor because it's already in the money. Does that make sense? How soon should we roll if the short option is in the money in the first few days? If it rallies up there, John, in the first couple of days, I'm more likely to pull the ripcord on the whole trade right away. It is just outpacing what we would expect that market to do in a very short amount of time. And I would expect it to want to come back up there again if it happened really fast. One thing we talk about on the floor is, you know, one of the little secrets of a floor trader is all these little shortcuts. And one thing to note is when we were looking at this strategy, and I believe it was in AMD, Delta tells you the probability of it being in the money. But one thing during the life of this option, excuse me, Delta also tells you the probability the market will come up and kiss you, is what we used to say, and kind of kiss your strike, where AMD has a probability of trading up to 16 during this lifespan, but this probability says it's going to settle outside of that. But that doesn't mean it can't come up and trade 1650 and then come back down, right? And still make those probabilities happen. So our little trick here is take the probability times 2, and that is the probability of being tested on your strike. So it's a 37% probability I will be out of money, or out of the money with my strike at expiration, but 2 times that, we're looking at, there's a 74, 75% chance that during the next 45 days, AMD trades 16. Maybe one time, but there's a 75% probability it comes up, kisses the 16, and then comes back down. All right. And if your question was, when do you roll? I would be rolling in a situation where, you know, right inside or just outside, I mean, of that 7 days to expiration is usually when I'm going to be looking to roll out in time. Because that usually gets you like that 7 days to expiration and puts you right back into that 40 some odd days to expiration, which is giving us that big juicy premium. We'll be able to get further away from the market. We don't have to worry about gamma affecting our trade and things of that nature. Okay. All right. All right. So I'll leave this up for you. Oh, actually, one more thing. I'll just say thank you. I'll do on this one. All right. Later webinars, you guys, we're going to be drilling down on different options and different options components, how I trade those options, and when and where I find those trades appropriate. There's a link also right here. If you guys are watching this on tape delay, just kind of pause this video, type this into your URL. It's not a hot link. so you can't really access it from your video, but you can type that into your URL. Just want to thank you guys all for watching. You can contact us at 310-598-6677 or email me at trading@protraderstrategies.com. All right. So like I said, this is, I'm not going to be able to go back. That's the link. You'll just have to pause it. Like I said, 10 hours of video. There's all kinds of lovely nuggets in there for you guys to take away, even if you've been trading for some time. You can take advantage of it. Like I said, we've been going back and forth in the chat window, or in the questions box that is over there in the chat window. What happened to the standard deviation? I'm still talking. Hold on a second. All right. Standard deviation. Let's look for a standard deviation image. Oh, looky here, you guys. This is my, so this does. Okay, so here lies the confusion when we were talking 64 delta, and this happens a lot, right? So 0 standard deviation is right where we put this strategy. You build the standard deviation curve from where we started this strategy, right? So when I was saying 1 standard deviation call, that is from 0 where we are upwards to the 1 standard deviation. That is actually a 34% probability, okay? All right, 34% probability. Or let me get the half standard deviation one here. Where's my half standard deviation one? Let's go with this one. Didn't want to do that, but here it is. So half standard deviation. Well, this will be a little bit, hopefully, easier to digest. But anyway, the half standard deviation, what we're going to do is you add up everything outside of that half standard deviation. So you take the 15 plus the 9, let's just call that 24, plus the 4, we're at 28, plus the 2, that gives us 30. And then, you add up all the other ones and we start adding up to that. So that's that 36 delta. That's these probabilities outside here, okay? That's where you come up with that. All right. And then the 16 delta is the half, and that's basically, we're going to be adding up all the ones outside of that. Or sorry, the 36 is the half standard deviation. The 1 standard deviation is the 16 delta. Did I possibly say that wrong? I was saying the half standard deviation when I was saying 36 delta, right? 36 delta is the half standard deviation. The 16 delta is the 1 standard deviation. So the 16 would be the 9 plus the 4 plus the 1 plus the da-da-da-da-da. Okay. While he's laughing at me. I got the hee. Okay, got it. John, are we on the same page now? But I do know what you mean with, you don't add up both sides of it. You got to look at it like pluses are the calls and the negatives are the puts is a way to look at it also, right? So this would be the at the money call or put right in the middle. And this is just the out of the money put and just out of the money call, right? We all good? We friends again, John? All right, good enough. Good enough. So, and John, believe me, that was not the first time I've heard that question. A lot of people will do that because, when we're taught with like our grades or something like that, usually they'll throw out this and they'll be like, okay, all of these are A's, all of these are B's, or actually, no, sorry, it's this, isn't it? It's A's, B's, the C's are the 68%, and then D's and F's, right? So that's where that whole thing comes from. But they're taking both sides of it. In options, we have the calls to one side and the puts to the other side. So to the 1 standard deviation, 34, and then that's not right. It's because this is 50%, and that I'm confusing myself with that chart. But the 50% is from this line to that line, from this line to that line, is what is 16%. So that's the 1 standard deviation. The half is not represented on the other one. right? That's about it, you guys.